Oh, Mum, we're on.
Excellent. So, good morning. Officially, we'll start this morning's presentation. So, thank you for joining us for our forecasting and business planning workshop. Or, as I said in the emails and in the invitations, it's the world has changed. I don't think anyone can claim that where we were in start of March, February time, seems like a lifetime ago now, where we were all moving around and meeting up with each other and holding networking meetings, face-to-face meetings. Business was what was normal. Is maybe, I don't know, hopefully it will come back, but certainly not for the foreseeable future. I don't know about you, but I think that having the situation that we're in at the moment is likely to last for at least another 12 months. And thereafter, I think businesses and people in general will have got used to using technology and not spending quite so long in the car and on trains and all the rest of it. So I suspect that where we are now is maybe not quite the new normal, but it's got to be fairly close to the new normal. So why are we running these events? Well, we're running these events because business, as I say, has changed. It's changing, and it's changing rapidly. So we have to be able to adapt our business to be able to cope with these changes and to be able to cope with what's new. So what are we doing this morning? Well, we promised today what we will cover is, obviously you're here now, so you will sit in on our free business planning and forecasting workshop. So that's first tick is already done. During the morning, my colleague Mark is going to give you some guidance on how to prepare your business plan. You know the old adage, failing to plan is planning to fail. So we have to know what the aims are, and then obviously work our way back to how we're going to achieve that. So we'll give you some excellent tips on how to do that this morning, and specifically at the end of the presentation, sometime this afternoon, you'll get a link from myself that will give you the ability to download the tool. It's completely free of charge that Mark will be walking you through today. It is really simple to use, however, it is also extremely comprehensive. As part of that tool, we were also providing a report generator that you're able to put in the additional information, the aims, the aspirations, the strengths, the weaknesses around the business, and then really be able to produce something that's comprehensive in order to go to lenders. Now, whether that's today, tomorrow, next week, next month, if you're looking for a CBILS loan, or equally as important is looking towards the future. Once we know what the new reality looks like, what funding you're going to need, what equipment, what other resources you're going to need, and what does that whole piece look like as far as the business is concerned going forward. So that may very well involve requiring additional working capital or fixed capital of a longer term basis. So we'll enable you to do that all through the same system. We're also giving today a free cost saving and opportunity analysis tool, focusing specifically on the situation where we are now, how to deal with COVID, making sure that you're compliant, and equally making sure that your business is in as strong a position as it can possibly be once we come out, once we know what's going on, once we get past this initial furlough period and all the rest of it. So hopefully you'll find that worthwhile. So what we're going to do today specifically is we're going to help you to create a 5-year business plan and forecast. Now that will be very detailed for years 1 and 2, so month by month forecast and planning for years 1 and 2, exactly as you would expect to see it both in your own business and from a funder's perspective, and then giving you the opportunity then to look at years 3 to 5 in more of an overview situation. Welcome to anyone who's just joined us. Good to have you with us this morning. As I say, that will support your funding requirements if required. If you don't require funding, something you should still be doing. As I say, failing to plan, planning to fail. Every business owner should have, ideally, a written down, a fully costed strategy and plan for where the business is going and how they're going to get there. And without that, it's the old adage, you don't know where you're going. If you don't know where you're going, how are you going to know when you've arrived? How do you know you're heading into the right direction? Crucially though, and uniquely, this funding model is actually completely accounting system agnostic. So you don't have to be using Xero. You'll see down the bottom of the screen, we're big Xero fans, Xero Platinum partners. And it'd be great if you do use Xero, because obviously we can hook straight into that and there's no data entry required. But if you're not, if you're using a different clouds platform, or if you've got a desktop system like Sage 50, for example, then that really doesn't matter. It's just a case of running a couple of reports. And again, you can use all the functionality in the forecast that we're going to share with you in a moment or two's time. So I'm going to cover 90 minutes. My colleague Mark is going to look at the data input, profit and loss and balance sheet, how you enter the historic data there, and then establish a baseline forecast. What do we mean by a baseline forecast? Well, that's effectively the forecast that you expect your business to work to over the next 2 to 5 years. So where do you think you're going to be in 12 months, 24 months, 60 months time? And then we're also then able, obviously on the back of that, to produce cash flow and balance sheets. What's the impact of the funding going to be? Now, funders really like to see this. So where are we now? Where are we today? What difference is the funding going to have on our business? And being able to demonstrate that you've thought that through coherently and comprehensively, and you can show the impact that that's going to have in years 2 to 5, for example. So Mark will cover that in a second or two. Also going to cover how to generate the report forecasts, what they look like, how you can input your own information into them and make them your own, and obviously then create funding proposals. And at the end, I'll touch on the cost savings and opportunity analysis tool, but you'll get that link anyways, say completely with our compliments in a few hours time, hopefully. So at this point, I'm going to stop my screen share and pass over to Mark. If you want to pick that up then, Mark.
Will do. Thanks very much, Sean. Good morning, everyone. It's just about, yep, still just about good morning. Right, I am now going to share my screen with you. And seamlessly, hopefully, if you can just give me a thumbs up, you can see something that says Model tab. Brilliant, there we go. This is starting to work, Sean. So, as Sean said, I'm going to take you through the universal funding proposal model. And what I'm going to do, I'm going to walk through a scenario with you, because it's always, you can always relate to things a lot better if we've got a scenario. So the scenario I'm going to talk to is an event management company who have been heavily impacted by COVID-19 pandemic. And what we're going to do is we're going to talk about how we forecast that business's performance over the next 5 years. And then we're going to talk about that business's funding requirements and how that will impact the business's performance. So we're going to cover two things. We're going to cover how we input into the model funding requirements to cover a short-term cash deficit, and we're also going to talk about how we input into the model some additional funding which is required to invest in a new asset in order for them to generate some short-term revenue. So I'll talk through that, but I thought it's better that we give an example scenario, and it's not a made-up one. It's an actual scenario that is happening. The numbers aren't the same, and we'll talk through that as our principles. But the model that you'll have access to at the end of or later on today is the model that you can see on the screen in front of you. And what we're going to do is we're going to go through how we input data into the model, how we set our baseline as Sean discussed, and then how we set our funding proposal and therefore the impact the funding is going to have on the business. You'll get a process tab, which is the very first tab you'll come across, which has got everything on it that I'm going to talk through today. However, you should only need to look at that for reference, because everywhere in the model there are tooltips. You just hover over a cell, it tells you what you should be entering, why you should be entering it, and then if there are any relevant calculations or any certain things to note, it will tell you that as well. So, but the process is there as a checklist for you to go through. Just say, have I done all of these things? So I'll crack on. So the first thing that we need to do is prepare our data. Now, data comes out of different accounting packages in different ways. So what we need is a consistent way of inputting data into the model. As Sean said, if you're on Xero and you're with Burgess and Bullock, then this model can automatically be produced. But essentially, we're covering the universal model here. So we need a consistent format of data. And what you've got, your first two, or your second and third tab, are a sample P&L and a sample balance sheet, which shows you exactly how you need to lay your data out. So sample P&L, really simple. First column needs to have all of your P&L nominals in it. And then from the second column onwards is all of your historical data about the business, starting with the most recent month the accounts are up to date to, and then heading backwards. And again, dependent upon the accounting software you use, it may just present it to you in this format, or you may have to just move some columns around. With regards to the amount of history, the model can facilitate 5 years worth of history, and that history is used in your funding proposal report. So that it will automatically give an overview of performance over the last 5 years, and it will give an articulation of that performance as well. Now, obviously, the more history, the better, because the funder can see exactly how the business has performed up to the point at which you're requesting funding. If you don't have 5 years, fine. If you put 2 years in, it will just show 2 years history. If you show 3 years, it will show 3 years history. So however much history you put in will be represented within your reports. What we'd probably say is a minimum of 2 years is probably the start point, probably the minimum you'd want to include there. So that's the sample P&L. Then we've got a sample balance sheet, so even simpler. So we've got our first column contains our balance sheet nominals, and our second column contains our totals. Now, the only thing you need to note is that the totals need to be at the same date that my most recent month is in my balance sheet. So I've got all of my trading history up to a point in time, and then I've got all of my balances on my balance sheet at that point in time. So that's all I need to remember. And once I've prepared my information in the appropriate format, I then just move on to the monthly P&L tab for the P&L. I paste my nominals in the yellow column, and I paste my months in the orange column. And then all I do is for my first month, I tell the model what month that month relates to, or what the most recent month is. So if that were April, I click April, and then all of the other months just calculate off the back of that. And all this is just for labeling. Again, if I'm not sure what I need to do, a little tooltip will tell you. So the year, the month, company name. Okay, well, it tells you, so why do I need to enter a company name? Well, it's because that name appears on all of the reports and in the narrative as well. So if you don't put a company name in and leave it as demo company, in all of the reports, you'll be referring to demo company rather than your own company. And don't worry, you can't, if you're not supposed to type into a cell, you can't type into a cell. So you're not going to break anything. You can only key information where information is required. So once I've set my P&L up in my right structure, I've then pasted it into my monthly P&L. The only thing I need to do then is use the column to the left, which is the chart of accounts category, and I just need to assign a nominal to a category. And it will be pretty straightforward because almost every P&L I've ever seen is given to you in a structure anyway, and it generally goes sales, cost of sales, overheads. So all you need to do is which of these lines relate to sales. I then assign a category, so either sales, cost of sales, or overheads, which I've already pre-populated this for you for speed. And then I've got my cost of sale lines, which I assign to cost of sales, and then I've got my overhead lines, which I assign to overheads. And the only thing I need to note, and it will tell you in the tooltip, it will say be sure to exclude headings, subheadings, and totals, because these should be left as select category. Because all the model is doing then is pulling through every number that relates to a particular category. So once I've got the format right, I paste it in, and then I just give my nominals a category. And then I go onto my balance sheet, and I do exactly the same on my balance sheet. So I just paste my balance sheet nominals into the yellow column, my balance sheet balances into the orange column, and then again I assign a category to my nominals, being sure to exclude headings, subheadings, totals, and subtotals. So that's pretty much, well, that is all I need to do to set the model up. So here I've classified these nominals as fixed assets, and again, if you're used to looking at balance sheets, they'll all come in the same format, so it'll be really, really easy for you to identify the correct classification. The only thing I would note is you may have what we call floating nominals. So you can set nominals up in various accounting packages to be a floating nominal, and that purely means based on the balance on that nominal, the software determines where it sits, whether it's a current asset or a current liability. So as an example, you might have overpaid your VAT, in which case it will show as a current asset, and really that should be classified as a current liability. So all you would do, so if you pasted your balance sheet in here and you'd overpaid your VAT would be appearing here as a balance within current assets. All you need to do is next to that line, call it a current liability. So regardless of where it appears in your balance sheet that you've pasted in, you can reassign it based on this blue column here, because that's the column that drives all of the forecast. Similarly, on your monthly P&L, if you had a line, don't know why you would, but if you had a line within overheads that actually you think should be classified within cost of sale, first and foremost, go and reclassify it in your accounting package, because that's the correct way of doing it. But secondly, you could just reclassify that as cost of sale, and that would mean that line would now roll up into your margin calculation rather than your overheads. But I'm going to leave those as they stood. So I'm going to change that back to current assets as well. And that's all you need to do to set it up. So go into your accounting package, download your history, make sure it's in the right format with regards to the P&L, and the months are going from the most recent month on the left hand side to the right, heading backwards in time, and then just paste it in and reclassify. So that then sets you up to be able to use the funding proposal model from that point on. So hopefully that's quite straightforward, and certainly once you get in there, like I say, above almost every single column will have a tooltip above it, which will tell you what I need to do. So if you forget anything, it will tell you what you need to do. What happens then is that information is then pulled through to our baseline forecasts. And as Sean discussed earlier, our start point is to project performance for this business over the next 5 years, i.e. what do we know with some degree of certainty is going to happen in this business. So as I've said, this business is an event management company. The numbers aren't, but our scenario is an event management company that has 9 nominals. So just as an example, if I go back to my monthly P&L and I go to my nominals and I put select category next to nominal, sales nominal 1, that now won't include that sales nominal in our forecast, and we start from sales nominal 2. So that's the impact that drop down in the blue column has. So we'll reclassify that as sales. That's now sales nominal 1, and sales nominal 1 now appears. And they're ranked in order of value over the last 2 years. So again, if they're not in, it doesn't matter about whether they're in ascending or descending order. When you paste the information in, the model will automatically rank them for you, put in the most important in terms of the model and value at the top. So here we're presented with the last 24 months worth of data. And the reason we present that information is so we can inform our forecast forward. Under normal business environment, we would just be able to use history as well as our plans for the future to then generate a forecast. What's going to happen to this business though, we can see here that we've got it lists your top 15 nominals, and then if you've got more than 15, it'll put everything else in an other line. I'll come on to this new customer piece in a second. So we can see for this business, the last 12 months, we generated £930,000, which was a 5% increase from last year, which was 887,000. So that's our base position. We can see the year-on-year percentage movement by nominal, and we can also see that percentage movement in each of the last 4 quarters, just so we get a good understanding of what's happening in this business going forward. Now, I've already adapted this model for purposes of this presentation. You are presented with, and under normal scenario, you're presented with a percentage applied figure in this column, because it will automatically generate a forecast for you as a starter for 10. And that will purely be based on what you have achieved on that nominal over the last 6 months. And it will apply that to your sales going forward for that particular nominal. What I've done here is I've just fed in my scenario over the next 12 months. And what's going to happen in this business is we're not going to do any sales for the next 3 months. We're going to do an average of 25% of our normal volume for the next 3 months. Then we're going to do 50% of our normal volume, and then we're going to do 75% of our normal volume. So what we're doing is we've got no business whatsoever, because no one's allowed to go to any events or exhibitions or anything like that. And then what we've done is we said, okay, well, we're going to have a slow build then over the next 3 months, and that's slowly going to build back up to a point where we're at some degree of normality, but that's not going to happen until the middle of next year. Now, the way that I enter information within the model, you can do it a number of ways. Essentially what I've done here is I've applied a percentage movement. So I've said there minus 75%, and I've applied that to some sales. And then what I've done after that is I've just referenced the previous year. So in this cell, as an example, I've said, okay, well, what did I do in December of last year? Because I'm just referencing that cell, and then I've taken 50% of that. I can, if I want to, just type in a number, and that'll have the same impact. Because this is Excel driven, it's been prepared in Excel for a reason. That's because most people are used to using Excel. So I've created my forecast there. You can do it however you want to create your forecast. So I've created my forecast by sales nominal. So that's going to drive £290,000 worth of sales over the next 12 months, which is a almost 70% decline. So this business has been impacted heavily, as many businesses have. Then what I come on to do is look at the following 24 months. And then what I'm assuming is, okay, well, there's going to be a build back to some level of normality. So I'm still going to be only doing 75% of volume up until August of next year. But then from September, I'm going to be back to where I have been trading over the last 12 months. So, and it's going to take that long in this particular industry, in this particular sector, for people to gain confidence, people to go back, and people to start behaving as they previously did. And there may be some of these, again, these might be sales channels, these nominals, and there may be some nominals that actually we want to completely wipe out. And if we and all we would then need to do is you either put a minus 100% in, or you can just delete the amount out. So really, really straightforward. And don't worry, you can't input information where you're not supposed to. So if you want to, you can't impact the total. You impact the total by changing the months in that period of time. So I've done my first 24 months by month. I then come on to the following 3 years, and I do them at a total level. And I either do that by applying a percentage change, or I do that by applying an actual number itself. So this line, as an example, I've got 5% in. If I want to put a 25% uplift in there, I can do. So again, really, really straightforward into how I apply that. And then I've just assumed that then the following years, year 4 and year 5, I'm just doing a 2.5% increase across the board. So I've not been hugely imaginative there, but I think I've shown you exactly what you do, how you do that, and probably you would apply different percentages to different nominals and or sales channels. If it is currently within the plan to introduce either new depends on how you've input the data. If it's currently in the plan to introduce new activity, then you would account for that here in the other line, and then you just call it whatever you want to call it, and then input the forecast in the appropriate cell. So what that's saying is I've got new activity there, and I'm going to do £5,000 a month going forward for that level of new activity. So that's where you capture any new activity that you're going to create, and you can either identify that by customer, or you can identify it by sales channel, or you can just identify it as one lump sum. So you can do a number of, you can identify it however you want. I'm just going to undo that because in our base scenario, we're just going to keep with our current sales channels. So I've got to a point now where I've got a business that was generating £930,000 worth of sales over the last 12 months. We're going to be severely hit this year and only going to do 290,000. And then in the following 12 months, we're going to get back close to where we were operating, but that's only going to be 843. And then we've got growth coming in years 3, years 4, and years 5. So that's from a sales perspective to get us back up to broadly where we have been operating. So again, different businesses will be in different situations and will require different ways of forecasting. So I've got a sales forecast. Now what I need to do is forecast my margin and my margin rate. And again, you're presented with exactly the same information. So what's my margin rate been over the last year? How does that compare to the previous year? And what was that movement year on year? So in this instance, it was 1.4% up year on year. Here's my margin that I've achieved over the last 4 quarters. And then again, in the percentage applied column, again, if you don't know why the number there is the number, just highlight over it and it will tell you that that's the margin percentage achieved over the last 6 months. So that's your starter for 10. It gives you the margin percent that you've achieved. Now, what I've done here is I've changed my assumptions, and I've just effectively taken the rate achieved in the month in the previous year. If I want to put something else in, and just type the number in. So everything works off of margin rate, and clearly, if you input a margin rate in a month that's got no sales in it, you're not going to have any margin. I'll show you how you impact that. So changing the rate that you enter will just change the cost of sales and therefore the margin. So again, you can input whatever you want. You can input a flat rate across the entire year, or you can follow the phasing as I've done here of the previous year. So what I've done there is I've just assumed, okay, well, the same margin rate will be applied. Now, clearly, the actual margin that you earn percentage is different because we've got a period in that 12-month period where there is no revenue. And then what I've assumed for the previous year is I've just put, okay, well, I've just added 0.25% to my margin rate for the following year. So my margin goes up to 71.6. So again, I don't enter my margin rate in the total column. I enter it in the months, and that drives the figure in the total column. But then for years 3, 4, and 5, I then just enter the margin rate that I'm assuming. And here I'm just assuming 0.5% increase year on year. So I've done my sales, I've done my margin. I now come down to my overheads. And what I've assumed various scenarios for my overheads. So if I take wages as an example, so what I've got in this instance, because we're closed, well, not closed, but just not got any activity, I've just got an amount which I'm topping up for my furloughed staff. So it's costing me £1,000 a month to top up my furloughed staff, and that's my assumption here. And then what I've assumed is a slow build. As sales build, so does my expenditure on wages, to get back to a point where by the end of these 12 months, i.e. March to April of next year, I'm now spending what I was previously spending. And then I've just assumed a flat 7,000 for the following 12 months going forward. So I've accounted for the fact that that what's happening with my business has meant I've had to furlough some staff, and assuming therefore that all of that credit gets back in the month for the furlough scheme, that will be the charge in the month. So what that then does is I then come on to the following 3 years, and I've just assumed there that there will be a 2.5% uplift on wages in years 3, in years 4, and years 5. If I then scroll back, and what you can therefore see is I've then taken various assumptions on various lines. So rent, I've just kept the same, kept that at £4,000 because we're going to continue to pay our rent. We've got IT, software, and consumables, which are the assumption there is the majority of those are direct debit, so that will continue. I've cut all advertising, travel, motor expenses, and client entertainment for the next 3 months. And then I've also cut travel, motor, and client entertainment for August as well. Again, these are just assumptions to show you what I've put within the model. I've labelled some of these overheads, and I've just left others as overhead 13, 14, 15. What you will also see within the model is in this percentage applied column, as it will tell you at the bottom in that note section, is you will see elements where you have, or nominals where you have minus 100%. Now the model's doing that because the assumptions for those lines are taken care of elsewhere in the model. So the assumption for depreciation, the assumption for corporation tax, the assumption for interest is taken care of elsewhere within the model. So it will automatically set those to minus 100%. based on the nominal description. But again, if that's not correct and that's not what you intended, then essentially you set that to 0, that will put that figure back in. So it may have done that incorrectly. It may have it has it to date, but if you don't feel that's appropriate for that line, then you just overkey the suggestion. You're in control of this. The model just gives you suggestions. It doesn't make you enter a number. Then what I've just assumed here is, as you can see in the calculations here, I've just assumed 50% of the previous year's spend for the first 6 months, and then back up to full spend for the following 6 for the rest of the lines. Is the facility to enter a bad debt calculation, which will feed through to your accounts receivables and your VAT calculation. So within your P&L that you paste in from your accounting package, you may well have a line called bad debt, and that will have historical charges to it. In order for any bad debt calculation going forward, in order for any bad debt figure going forward to flow through to the accounts receivables and the VAT calculation, you need to include the total here. Just take a drink. So what I've assumed here is, you know, this particular business is in dire straits at the moment. Other businesses, because it's a B2B, primarily B2B business, other businesses are going to be in the same situation. And unfortunately, I've assumed 35 grand's worth of bad debt within the next 12 months. So that's how I've accommodated that figure there. So I roll all of that together, and that gives us a point where we've made 214,000 in the previous 12 months. So great level of profit in the last 12 months. That now is going to reduce to a loss of 134,000. Based on a recovery, I can then get back to a point by the end of year 2 where I've made 158,000. So almost my next 12 months is offset by the following 12, pretty much within this business, which won't be dissimilar to many, many businesses out there. And then that'll go up to 180 to 190 to 200,000. So I'm finally back to a point where I'm on a par to where I was before all of this started. In this business, it's taking some time to get there. So that's how I set my baseline assumptions for the next 12 months. What we've got is, so we've had a question: does the system have a means of recording the assumptions? You'll see in the funding proposal that gets generated, we talk about the movement and the movement in profit, and there is a forecast report as well, which talks about all of the various assumptions which are in there. So there's not a one page which captures this is the assumption that I've made, but all of the impact of all of this is shown in the reporting. So this isn't the reporting part of it. Okay, so I've talked about my P&L, and I've set my P&L for the next 5 years. I then come on to probably the most important part of the model, which you'll probably spend a minute on, is the baseline balance sheet. Because I need to now set my baseline and the treatment I'm going to apply to each of my balance sheet nominals. So these are the nominals which I've got within my closing balance sheet. So as an example here, stock of 115,000 appearing in current assets. My current assets, I've got stock there. If I change that to, it's not, but I'll just show you. If I change that to current liabilities, that now appears in my current liabilities section. So that's similar with the P&L. That's how the selection on that on the chart of accounts category column drives the calculations within the model. So let's set that back to current assets. So now what I need to do is I need to look at my various balance sheet nominals, and I need to assign a treatment to them. And what do I mean by treatment? Well, on the process tab, what you will see is when I'm talking about my baseline balance sheet tab, you'll see these classifications, and then they will talk about how that impacts the model's calculations going forward. So that's on there for you to read as and when you use the model. what I'm now going to do is go down and assign these. I've already assigned them. So stock is assigned to stock stroke work in progress, and therefore the treatment I apply to stock and work in progress will impact that balance. Accounts receivable is a receivable and therefore will roll up into my receivables calculation. Bank account and PayPal are cash and therefore feed into my opening cash balance. And my rent deposit, well, that's just a rent deposit, and that's probably going to stay exactly the same for the next 5 years, and it's really irrelevant to what that means to the business. So I've classified that as other, and all that means is it's going to maintain that balance throughout my forecast. So anything you classify as other, either as an asset or a liability, just means it will maintain the same value throughout the forecast. So we only really want to concentrate on the elements which are going to change materially in our forecast. I then come on to my I then come on to my current liabilities, and I've got accounts payable, corporation tax, VAT. Aware that very often you might get 3 or 4 VAT nominals within your balance sheet, so you then just have to classify all 4 of them as VAT, and they would all roll up into the same VAT figure. Well, I've got some other payable lines, and then I've got a bank loan which I classified as debt. Then finally, on my long-term liabilities, I've got a court case which is it's probably been postponed for the moment in the current climate, but I've got a balance on my balance sheet which relates to a court case, and actually I haven't got a clue what's going to happen in that court case, whether it's going to be favourable or not. So I've just classified that as other, and again that will just maintain that as a value on my balance sheet going forward. So I've set my P&L baseline. I've understood what my balance sheet opening balances are, and I've then classified and assigned a treatment to those. And I now come on to looking at my 3-way forecast, which are the assumptions I'm going to apply to my P&L and balance sheet to generate my cash flow. So I'll just reduce the size so you can see all on the same screen. I appreciate I'm going through at pace, but again, there's a tooltip for anywhere I need to make an assumption or enter a piece of information. There'll be a tooltip. So, and then if you can't find it on there, it'll be on the process tab. So don't feel you have to come back to this recording. Everything you want is in the tooltip. So the first thing I'm presented with is my depreciation as a percentage of fixed assets. In the this year column, it will give you the calculation for this year, and that will purely be based on the depreciation charge in the year and the asset value at the start and at the end of the year. So that's purely what it's based on. So it will be a starter for 10. It may not be the actual depreciation that you apply, because you may have had accelerated depreciation in the year, or you may have done something around your asset valuations in the year, but it will give you a starter for 10. If actually in this business I apply 25% reduced balance, I just put 25% in, and then it applies that assumption to my fixed assets going forward, and that's the charge that will impact my depreciation. So remember when we went back to the, sorry, I'm on the wrong line. Remember in our baseline, we had a minus 100% for depreciation. Well, that's why it sets it to a minus 100%, because your assumption is included in this sheet here, and then that's what drives your final P&L. Again, from an interest perspective, it said, well, what's your interest been over the last 12 months? And therefore, from the debt balance, I can work out what the interest charge percentage is. But again, because of some journals, that may or may not be reflective of the actual charge. Let's assume in this instance that it is, and we've got a 12.6% loan, which we've already identified on the balance sheet as debt, and it's got a £5,000 outstanding balance. So that accounts for the interest element of the loan, and I'll come on to talk about how we account for the capital element. The accounts receivables and accounts payable days, the assumptions which drive those numbers are down below. So I'll come on to those in a minute. You can't change a number there. That's just there to note, to keep all of our days calculations within the same section. So the next row you come on to is the inventory days. Now within this business, we've got a really high level of stock and work in progress. Let's assume it's all stock. So it's 116 grams worth of stock. Now, what we need to assume is so we've had feedback on a number of applications that have been made. There's been feedback from the funders. This is what they'll generally look for: is how are you managing some of those working capital requirements within your business, rather than just asking for money. I.e., if you're carrying 115 grand's worth of stock, is that the appropriate level of stock to carry? Do you actually think you can work with less stock? Because therefore, if you can work with less stock, your cost of sales, i.e. your cash requirement, working capital requirement in your early months can be dealt with to a certain extent through your stock. Now, these numbers going up may appear to be to look a little bit odd, but effectively what these represent are your inventory days to that point in time. And because we've got no revenue, we can't get rid of any stock because we're not selling anything. So that's why our days are actually increasing here. And then what we're doing is we're slowly working down to a position over time where we get down to around 80 days and a level of stock which is in our balance sheet, which is around about 50 grand. So we've decided as a business, actually, we think we can get down to about on 800 to 900,000 pounds worth of revenue. We think we can get down to 50 grand's worth of stock. However, we're not going to be able to do that straight away, but we are going to do that over the next 12 to 24 months. So if I then go up to my assumptions and carry on down, so I've dealt with my depreciation, interest, and stock or inventory days. Now I now come on to corporation tax. So again, if I go on to and this is why I said this is probably the most important sheet, because it does drive all of your balance sheet and cash flow calcs. We've already identified that we've got a tax liability of 15 grand on our balance sheet. Let's assume for these purposes that this business has a March year end. So I'm going to change that to March. Let's assume this business has a March year end. So we've got 15 grand corporation tax, which is on our balance sheet at the end of March. So the top line here refers to when that liability hits your accounts, and the line below it refers to when you actually pay that liability. So we're not going to pay that 15 grand until December. Okay. Then in March of next year, well, I'm not going to recognize any corporation tax liability because I've made a huge loss. So I've made a loss of, I can't remember what loss I've made in that year. So I've lost 144,000 in that year, profit before tax. So I'm not going to recognize a corporation tax charge in my accounts, which therefore means I'm not going to pay anything out in the following December. I then come to the following March. And actually, and let's assume, I don't know the tax details of this business, but my profit then in the following year is only 140. My loss in the previous year was 140. So I'm probably not going to recognize any corporation tax liability in my accounts the following March either, which means that in year 3, I'm not going to pay any. I do therefore then start to recognize corporation tax liability in my accounts from year 3 onwards. So there's an amount, and I've just made these numbers up. There's an amount in year 3, which I then pay in year 4, amount which I recognize in year 4, which I then pay in year 5, and then amount which I recognize in year 5. So that's how I account for, and again, all businesses' tax affairs are different. So you will require some thought and probably a little bit of help in understanding what that number may or may not look like. But that's how I account for my corporation tax liability and therefore the payment of that liability. I then come on to probably the most important bit for all business owners is actually what amount of dividend am I going to get paid. Now, regardless of what this owner has been paid, actually they've worked out for the next 12 months they can probably get by on £1,500 dividend a month. So £1,500 we've put in over the next 12 months, and what we've assumed therefore is then the following 12 months that goes up to 2,000. And then in year 3, when I've started to get back to actually now cash is a little bit easier, 30 grand, 36 grand, and then 48 grand in year 5. So the business is starting to generate more money now, so I can afford to pay myself. However, what we've assumed is kind of the bare minimum what they need to get by over the next 24 months. I then come on to capital expenditure, and again, literally all I've assumed here is that there is going to be a requirement, and there is a requirement every year of 40 grand capital expenditure, and the depreciation percentage that we've input up here then drives the depreciation based on that capital expenditure being added to your balance. So all I've done here is assumed 40 grand is required every year, yeah, to keep the lights on, to keep things going. Then I look at debt issued or repaid. So on our balance sheet, we had this £5,000 here. I've just assumed that we're in the last month of that, and actually that our final payment is April, and that's going to be repaid in April. And then that will then reduce the balance down to 0, and then there will be no further interest charge going forward. So we have a final little bit of interest being charged in April, and then no interest going forward after that. Again, this is existing debt within the business. This isn't what funding am I requesting. This is my existing debt. I haven't assumed it here, but there may well be some equity that you issue or repaid. So I don't know. Somebody may have offered to invest, make a short-term, make an investment in the business for some equity to help you out with cash. That would just be recorded there. So if they invested 50 grand, your 50 grand would just go in there. And what that would do is that would have the relevant impact on your shareholders' equity and also on your cash in bank. I'm going to take that out for the moment. So they're my overall assumptions, if you like. And then I have 3 more assumptions to make, and they're quite key assumptions because they relate to VAT, they relate to accounts receivables, and they relate to accounts payables. So I come down to my workings section, and at the bottom, again, wherever I have to enter some numbers, it will be coloured. If I don't have to enter a number, I can try. I won't be able to do anything because it's all calculation driven. So you can't go wrong with the model. You can't enter numbers where you shouldn't, because everything's protected other than where I should enter. So the first thing that I look at is my average output VAT and my average input VAT rate, because that's going to determine the amount of or the net movement in VAT relevant to my purchases and revenue over the coming months. So again, I've got a tooltip which is there, which will tell me why am I entering a number in this cell, and also just a real brief guide as to, well, where can I get that number? So as an example, output VAT, no, the approximate, and it's proximate, input VAT calculation can be calculated from the relevant boxes on your VAT return. And the approximate input VAT can be calculated by dividing box 4 by box 7 on your VAT return. So it gives you an approximate number. All I've assumed here is 20% and 17% going forward. So I've got my approximate VAT rates. I then now need to look at the VAT cycle that I'm on, which will determine when the balance is paid. So if I change this drop down, that changes when I'm going to pay my VAT. So as an example, if I'm on a March, June, September and December VAT cycle, the assumption is that you pay your VAT at the end of the month following your VAT cycle. Now I know that sometimes that can go over into the following month. It depends when you pay it as a business owner. That's fine. If I don't want to pay it in that month and I want to pay my 9461 the following month, I'll just delete that and put 9461, and that will just take care of the payment in the relevant month. If I've got a scenario where I'm not paying any VAT for the next 12 months, I just delete it. And what it will then do is say, okay, well, I know what my opening VAT balance is. I know what my revenue was in the month. I know what my costs were in the month. I know the relevant output and input rate to apply. Therefore, I know what my net movement is in VAT liability in the month, and therefore I know what my running total is. Now, obviously, in this business, because we've been really hit hard, actually, what we're seeing here is a reduction in that liability. And actually, the first one of these that I did actually made me think about that. You know, most businesses will be in this instant in this state where, you know, they're not paying their VAT, but pretty much their VAT liability is going to reduce probably every month for a fair few months going forward. So we get down to a point where our liability is down to below £1,000, and then it increases as sales start to come in, and as our costs increase as well. So we're going to assume there that we're going to I'm just going to leave that as it was, and assume that we're just paying our VAT as and when it's due. Then I come on to my receivables calculation, and this is my percentage of receivables recovered. And again, if I'm unsure, just hover over the tooltip, it will tell me what I need to do. And what this says is what proportion of my receivables at the start of the month plus any receivables which I've generated in the month am I going to recover in that month. So as an example, if I am an instant payments business and I have and all of my revenue is received either via cash or via instant card payments, it would pretty much be 100, because you just receive everything in the month, or it might be 99%, and there might be a little bit that you do on invoicing. This is a B2B business. If I scroll down slightly, I'm already given an indication here of what my accounts receivable days were from the previous 12 months. So therefore, I know broadly where I should be operating at, but I know that actually businesses are in exactly the same situation that I'm in. So if I think I'm gonna operate at 30 days accounts receivables, I'm probably smoking something. So generally, what I'm going to do is I'm going to reduce that number, and of my outstanding closing receivables, what I've assumed here is that for the next 3 months, I'm going to get barely any of that in, so 10%. And then as businesses start to go back, as I go back, then that starts to slowly build. So I go from 10% to 15% to 20 to 25 to 30 to 35. And what I'm doing here, so the assumption here will tell you what your average accounts receivable is over that 12-month period to that date. So I'm back up to 45-50% by October, but I've still got a few months of unwinding to do. So I remain at 50% of my receivables recovered in the month, and then by the end of March, I'm back down to roughly my 30-day figure. I've got a question. Baseline balance sheet is the opening balance of your current year going forward. So, Sean's answered it. There we go. Thanks, Sean. So, they're my assumptions for receivables. I've now got my assumptions for my payables, and again, it's exactly the same calculation. What proportion of my payables, of my opening payables, plus any payables due in the month, do I actually pay in the month? And what I've assumed here is actually, because I've got a lot on direct debit, I can't really influence a lot of what I pay. So some I can, but I've assumed 25% there, because let's assume a lot's on direct debit, and either I have, either I benefit from that service and pay for it, or don't pay for it and don't have it. So again, this will be different for different businesses dependent upon their cost structure and how they pay for things. But the assumption here again is that actually we'll stick with 25% for 6 months, and then we'll go back up, and then we'll slowly get back to a point where we are paying people in a similar fashion to where we had been. So previously we'd been at about 30 days for both, and we can see that actually we get back to around about that 30-day mark by about the middle of next year for our payables. So they're the assumptions that I make. So what we've tried to do is keep this as simple as possible, however, including all of the relevant information. So we need to input our VAT assumptions along with our receivables, along with our payables, and hopefully, because we're talking in, you know, what percentage do I actually recover, that's a lot easier to understand. So I then come up and say, okay, well, what impacts that had on my cash? Because that's probably the most important thing now. And I'm looking here and I'm going, right, I've got 34 grand in the bank, and oh dear, by May that's gone. I've got no revenue coming in for the next 3 or 4 months. And then actually, we're getting into a position where I've got a low point now. If I follow that through, I've got a low point of about £170,000 in my business. So that the impact of no revenue and then a slow build in revenue, the impact of fewer accounts receivables in the early days. The impact of our assumptions around the capital expenditure requirements in the business in order to keep the business going, the impact of the dividends which are required in the business, and then the corporation tax payments. That's what gets us to a point where we're now we've now got at a low point of about 170,000. So that's our baseline. That's what's going to happen in this business, and it's not a pretty picture for this business, much as it won't be a pretty picture for a lot of businesses out there. So now what we need to do is, so we've articulated there very well exactly what's going to happen. Now we need to talk about what we're going to do. So in this business, we're going to do two things. We're going to apply for some funding to negate that medium-term cash deficit. And we've also identified an opportunity in online events. But in order to do online events, we have to develop some software to be able to do that. So we've assumed we need 50 grand for that. So they're the two things which we're going to do in this business. We're not just going to rely on a bit of cash and just carrying on operating as we were. This is a new world, new way of working. And actually what that has done is that's identified an opportunity for us to go into virtual events. But we need to invest in order to be able to generate some revenue. And what we do is we now use the funding tabs to do that. So my funding forecast tab, what that does is that says, okay, well, let's just take your forecast assumptions in your baseline forecast and we'll flow those through. Now you need to talk about the impact this funding is going to have on your business. So here I've left everything exactly as it was by sales channel. And here I've called it new website, stroke online events. Okay, so that's a new area of activity for us. That isn't in our plan because we haven't got the funding to facilitate it. We need funding for it. And then what we said is, okay, well, we reckon we can get that off the ground to a certain extent in June. So June, July, August, and then we're going to slowly build our revenue. Now this is additional revenue over and above our baseline. So we reckon we can get 55 grand out of that this year. And then if we flow that through into next year, we reckon we're up to 10 grand a month. So 120 grand a month for that element going forward. And then I reckon 150 grand, 180 grand, and 210 grand. So we're going to generate quite a lot of revenue out of that by years sort of 3, 4, and 5. And that revenue is going to build up this year as people start to understand and get used to our online way of event. I've no idea what these look like, by the way, but our online events. So I've added that additional revenue in. And what you're given here is you're given, okay, well, from a sales perspective, that was my baseline for the year. I've now got a new year one total of £345,000, which is still a huge reduction on the previous year, but it's not as much of a reduction. I then follow on and I say, okay, well, my year two, my baseline was 843. Now I'm at 963. And I'll go on to year three. So my baseline for year three was 896. Now I'm at 1036. And this is about articulating the impact the funding is going to make on the business. And that's the real key. That's the important thing. So I won't go on to 4 and 5 because you're all smart people. You can understand what that tells you. And then I look at my my gross margin. Now I've been quite what I've assumed here is that actually that activity is delivered as a lower cost of sale than my general activity. So actually I'm going to see about a 1% increase over and above my baseline in my margin rate. So I put in 1% here, and all that does is increases my margin rate in the month by 1%. So that was quite simplistic, but as it's not a huge proportion of my total revenue, it's not going to have a huge impact on my margin. But that's how I would, if I was investing in machinery, which was going to make my product far more efficiently, essentially you probably put a greater number in there, and it's going to reduce my cost of sale, and I might be able to make my product at a 10% increase in margin rate. And that's how I would account for it there. But let's go back to this example. And then what I've done is I've said, and I've kept it separate. So all of my overhead assumptions flow through, and then all I've got down at the bottom is new website related, I've called it OPEX, operational expenditure. So it's going to come at a cost of 5 grand a month. That 5 grand may be people, it might be infrastructure, it might be a mixture of the two. So it doesn't relate to designing it, because obviously that's a capital expenditure. It relates to the OPEX that relates to that. And then I'm just going to flow that through at £5,000 a month going forward. So this is great now, because I've got a business that, you know, all right, it was losing 134 in year one, and actually, because of the costs, the operational costs, I'm going to lose a little bit more in year one, but I'm going to come out of it, and my year two profit is now going to be at 189 compared to my 158, and I'm going to be at 234 compared to 181, etc., going forward. So what I've said here is actually in this business, my year one is going to get worse a little bit, but the future is a lot rosier. So that's great, but I now need some money to be able to do that. That's not just going to happen organically. You're given your funding balance sheet there just as a note. You can't do anything on there because you've already set your base balance sheet, so it's the same balance sheet. And then all I need to do is, okay, right, in order to do all of that, what difference does that make on my cash flow assumptions? Now, in this instance, I'm going to assume that everything stays the same other than actually my funding requirements. So in this instance, what I've said is I need £250,000, and I'm going to spend 50 of it on this online events system. And actually, the rest of it will remain exactly the same as is in the baseline forecast. And the only thing I need to then do is say, okay, well, when am I going to start to repay that loan? So again, I've assumed here, so I've assumed there's going to be no interest on that for the next 12 months, which is why I've zeroed everything out for the next 12 months. And then that loan is going to start to be, the interest on that is going to start from June of next year at 5.7%. And I'm going to start to repay that back. I just assumed over 5 years, so 50 grand a year, 4,167 a month from June onwards. Now, technically, that's not exactly how the loan repayment will work. It will slightly over and undercharge in some periods, but it will be there or thereabouts. So that's my capital repayments, and that's all I've done. So I've accounted for my capital repayments there. And now what I've got, actually, as a result of this, is I've got a position where I fixed my baseline. My baseline went down to a position of, I think, about minus £170,000 worth of cash. And what I've said there is that I'm going to invest in my business to generate additional sales, and I also need some funding for short-term cash deficit. And now my cash low point actually is around about the 20 grand mark. Still at the same point in time, but now I've got a low point which is above zero, and I may choose to allow a greater or lesser amount of contingency than that. But now I've got a point where actually I'm operating off of a base where I don't go into a negative cash balance. So what you've then got, before I click this generate funding proposal button, because I missed it off the last webinar, you've then got a forecast report, and that forecast report, if I just show you what it looks like. So this is where you can view your assumptions. So you got your forecast report, you can click it to generate a PDF, and it will generate a PDF for you. And that will then just highlight, okay, well, here's my summary P&L over the next 5 years. Here's some graphs to show that performance and that trend, and how that trends over that period of time. A sensitivity table which shows you, yes, I've assumed in year 5 a 74% margin and a 4.2% compound annual sales rate growth. If I were to achieve a higher or lower degree of sales growth, or I were to achieve a higher or lower margin rate, this is the impact that would have on my profitability. So obviously, higher margin, higher growth will give me more profit. Lower margin, lower growth will give me less profit. And this is the sensitivity analysis, which will be important to be able to discuss and talk to with the funder as well. To say that, you know, this isn't, you know, even if things don't go quite as well, I'm still in a position where we're making profit. And then you get some, so there's my, and then it concentrates on the next year. So last year, this year, next year, summarized overview of performance. And then I've got some graphs on sales, a table, my key nominals, an element for you to type in some commentary if you wish for each of those areas. And then all you need to do, so we've got sales, we've got margin, we've got overheads, and then we've got profitability. We've got a walk forward showing you how you've moved from last year's profit to this year's profit. Huge impact on sales in the next year, which is going to decrease your profit. We've made a little bit of saving in some of our overhead costs, which has mitigated some of that, but that's how we're going to get to our loss next year. And then finally, we trend the profit out, and then you get a detailed P&L and balance sheet, sorry, a detailed P&L based on your next 12 months. So that's the report, and then you just click create forecast report to generate that forecast. Then what we've got is the main funding proposal. So if we go back on the funding through a forecast tab, you've got this, once you're happy with everything, you've got this generate funding proposal tab. So if you click that, you'll get a box come up which will say, well, where do you want to save this? And that's all that's saying. So I'm going to save that. I'll save it to my desktop. So that's, and what you'll get is you'll get a dialog box which will come up, which will tell you when that has been saved. And what this is doing now is it's taking all of the history, it's taking all of the assumptions within the baseline forecast, all of the assumptions within the funding forecast, and it's consolidating all of that together in one document. Tells me it's complete now. In one document which is designed for you to be able to articulate not only the funding you require, but your business, the environment you operate in. So if I go in now, open that up it's on another screen, so bear with me. So there we go. So if I open that up, now I've pre-populated some of these just to give you an idea of what to put in the boxes. Ordinarily, it would appear this box would be blank, but essentially what you would get is you would get a blank box, and it would tell you, right, this is your executive summary. So what do I need to provide here? So you know, what we've said is the funding that we require, over what, you know, why do I need it, and over what period. We then need to talk about the profile of the company. So give the lender an understanding of the company, the market it operates in, the history of the company, and anything else you feel is relevant. You're then given an indication of the financial performance of the business up to this point in time. So here we entered 5 years worth of history, and this is where the history pulls through. So we can talk about, and this is automatically generated this commentary here. If you don't want it, you can just overtype it. It's not, you don't have to go with the commentary that's generated. You're given a tip on, what should I include here. So you're given a view of history, so we can see the 5-year trading history of this particular business from a revenue, margin, profit, also the net worth of the business currently, where it stands, just broken down by the key balance sheet areas of fixed assets, current assets, and then total liabilities. And then an understanding of historical revenue and profit within the business. So this business, you can see, is a highly seasonal business. In that we're strong in the summer months and in December, and then to a lesser degree the other months. So that's given about that gives a view of the trend of the business. So I've talked about, my exec summary. Why are we here? Why am I even presenting this? And then I talk about the business. So the company profile, financial performance of the business, some graphs to show you exactly what that's looked and what that looks like. Then the bit which a lot of people are scared of, but ultimately it does show what you're talking about when you're talking about your business. So a simple SWOT analysis to talk about the strengths, weaknesses, opportunities, and threats. So strengths and weaknesses, internal, opportunities and threats are external. But again, you're given some guidance on what to do and what to include. But again, this is all there to give the lender comfort that you actually know what you're talking about, your industry, your business, and the numbers. Yes, the numbers are the numbers. What gives me confidence in those numbers? And I then come on to talk about my loan requirements and what that's to be used for. So what I've done here is I've just broken that down to say, okay, we know we asked for 250 grand over 5 years is what we've asked for. 180 of it is to cover the short-term cash deficit of the COVID-19, because that's from our baseline. I think we got to a point of around about 170, 180. 50 grand of it is for the creation of a new e-commerce website to drive incremental revenue. And then there's 20 grand's worth of contingency in there within that number. So that's just a high level breakdown of why I'm requesting the 250 and what it's going to be spent on. Then we talk about the impact the funding is going to have on the business. So here, and again, this is automatically generated, but if you don't want to use that, just type whatever you want in. So, but what this says is it talks about your sales, it talks about your margin, talks about your overheads, talks about the impact it makes on profit, and it talks about the impact it makes on your cash flow, as we call it. So we go from a point where this investment increases revenue by an average of 18.5% each year. Adds that 1% we added to margin, that's accounted for there. So profit is going to increase by an average of 15.5%, and we'll deliver it. Overheads are going to increase as a result of the additional £5,000 a month, but overall it will deliver an increase of profit of 94k by year 5. So again, we're articulating the impact that this funding has on the business. We then input some key assumptions that we've made within the model. So this is where they would be captured, and then we reflect the impact using exactly the same graphs that we used before. So this is our baseline, this is our with funding proposal, and we can see here that revenue, whilst it's only slightly impacted in the first year, gets to a point where we're going to generate a lot more revenue as a result of this funding. Our profit is going to be worse in the first year, but then year 2, 3, 4, and 5, it's going to increase. Our cash balance, importantly, is now no longer going to be negative. It's going to be positive in the first year and positive in year 2, whereas in the first 2 years, we were at a point where we had a negative cash balance. And then how that impacts the net worth of the business going forward as well. Then finally, what the next 24 months looks like in our revenue and our profit, and then just an articulation of how that's moved your moving annual total. Then finally, a section, if I want to include any other information, and then a detailed P&L, balance sheet, cash flow statement, and then the appendices, which has got all the working schedules in it as well. Finally, if you want to, at the end, there's a section where you can list any of your fixed asset base, because we haven't really talked about that. So this is our fixed asset base, and that's basically the balances we've got. And then any outstanding debt, which is something they will be interested in. And here's where we had I made it up, NatWest Lane, balance of £5,000, was over 5 years, but we've got like 0.2 of a year left on it. In fact, I think it's probably 0.1. And then all you do is you just print that out, and then that will come in a 6-page document, which has got all of that information on there. Really, really detailed, but has all of the information that will be required without you having to go and find it and search for it in different places. So I appreciate that's taken up an hour of your time. Hopefully it was an hour well spent. And then, like I say, if you have any questions, please feel free to ask, or put it in a chat, or you can email afterwards. So however you wish. So thank you for listening. I'll now hand you back to Sean, who hopefully will be able to continue if I stop sharing my screen. And then hopefully Sean can share his.
Can you hear me okay? I think Sean's stuck on the phone to the hospital.
Oh, okay.
He can't do the proper wrap up.
Okay.
So apologies for that. So are there any questions? Please do come off mute and feel free to ask Mark any questions that you have.
No? Okay, good. Well, hopefully that means that it was quite self-explanatory, and I haven't bamboozled you. Like we said, we've tried to keep it as simple as possible and only include the relevant information.
So Sean had a couple of slides which unfortunately I don't have available to share with you. So one of the offers that Burgess & Bullock are making is there's a short-term cash flow audit tool which will identify potential things that get missed and issues related to health and safety. The plan is that this meeting has been recorded. I think Sean's planning to get this recording up onto the B&B website so that you'll be able to access it afterwards. And in due course, there'll also be a full set of instructions for how to complete the spreadsheet. And finally, also, obviously, the spreadsheet is not very good if you can't access it, download it, use it. So you should shortly receive an email from Sean, which gives you access to download the spreadsheet. You also have access to the cash dashboard to look for short-term savings. And if you wish to attend at all, sorry, again, or you know of anybody else who might benefit from attending, who might benefit from the financial model, please by all means do refer them to the workshops. And again, that will be detailed in the email that will come from Sean. So yeah, any questions, any comments, any observations, any feedback from Mark?
Hi, hi, it's Simon Hall here. Just to say thank you to, well, Sean's on the phone, but yeah, thank you, Mark. I think that was really useful. Whilst I've seen the model before, I think to actually be shown it, you know, in real life, so to speak, is good. Can I just make one observation? Just I wonder whether maybe I missed where that would get inserted in. There's almost like an other income section, if you like. So you know, I'm just thinking about, you know, you talked about furlough monies coming in. I think personally, I'd quite like to see a, you know, even if you had a separate other income line, it just says, well, you know, because it might come in a different month or something, or whether, you know, I know you can probably play around. I'm guessing you could play around with, you know, the cost bit anyway, but I suppose it's just to make it clear anywhere type thing, or even if there's anywhere, if somebody's got some, I don't know, they might sublet or something like that. That might have an impact. So
yeah, I think where I would do that is, so if you wanted to show that separately, it might say, if you remember, I just put the kind of the net movement in my gross wages.
Yep.
What you could do is you could show your full gross wages, and then maybe in your either another line in your overhead section, or in your sales section, you could include the kind of the income as a result of that.
I'm with you. So you can almost put a negative,
Yeah,
or a credit entry in your overhead.
I do it in my overheads, because if you do it in your
Okay.
sales section, it'll apply a margin
Versus
rate
your
to
margin.
it.
Yep.
Yeah, so I do it in that overhead section.
Okay, makes sense.
Okay.
And any other questions? Can I ask a question just while we're there? So the some of the feedback we've had in the past is that the workshop is incredibly detailed, and for the average business owner, it's maybe too much detail. And I think one of the observations is that, yes, for the initial intro, it probably is a bit frightening and a bit daunting. However, it is, you know, step by step. And in order to give you the ability to actually download the video and go back and recap on exactly what Mark's just gone through, he had to run through it on the workshop in order to capture it on the video, so it's there for you to capture later. But if yeah, could you please just give Mark some feedback, anybody? If you don't wish to do so, that's absolutely fine. But
Steve, I think it is quite detailed for people who are not familiar, you know, not used to heavy-duty spreadsheets. But you know, as you say, it's just a question of practice. And I'm just following on from Simon's comment there. I saw another presentation where they recommended with payroll that we actually put every member of staff line by line, especially now with the furloughing, maybe some people coming back part-time. So, and I think from what I can see there, that's quite possible. You can just break it down, just add the extra lines as though they are part of the nominal ledger. And so you could then decide which ones you're furloughing, which ones you're bringing back, and which percentage. But I think the flexibility is built in there. So I think it's a question of getting people used to it.
perfect. Thank you, Mike.
Yeah.
Can I just add something as well? I think it's been really great having Burgess and Bullock on the line every single day with different emails and different content for us business owners. It makes us feel, particularly those of us who are working from home and have small businesses, that we haven't been forgotten about in the grand scheme of things. And I just wanted to really thank you for that, because it's been really informative.
Okay, thank you, Alice. That's appreciated. Just so you know, Sean's got one of his a close family is in hospital at the moment, so that's the only reason he's not actually answering on his own behalf. But thank you very much for that, Alice. Okay, well, if there's no other questions, going once, going twice, going 3 times. Okay, thank you very much indeed. Have a good day, and obviously any support or any help you want, please do get in touch with Burgess Bullock. We're very pleased to help you in any way possible. Thank you.
Thanks, guys.
Thanks.
Bye.
Thanks,
an eye,
mate.
Sean,
How
if
did
you're
that
still
wind
there.
up?
No, it was good. It was good that you got Alice went out of
Connie,
the way to
where
say
are you?
thank
Hang
you
on.
so much.
I'll put you on. That's it. Let me take you off mute. Let's try that.
Okay. Yeah, no, it was good. So no questions again. We did make the point of yeah, the workshop is incredibly detailed, and actually it was one of Mike's customers that had given that feedback. So Mike chipped in and said, yeah, but it is actually very straightforward if you're not used to heavyweight, you know, spreadsheets. So he was helpful on that one.
Good.
Alice went out of her way to say, you know, as a small business owner stuck at home feeling a bit lonely, all the information coming out daily from Burgess and Bullock has been absolutely fantastic. Thank you so much. Just wanted to really just give great thanks. So
That's nice.
yeah, you're getting positive feedback from that one. So yeah, no, it was good. It was positive.
No, brilliant. Thanks. I did send you the slides through, but it was the old version anyway, so I could turn myself
That's
down
all
a bit of feedback. But that's cool. Thank you for picking that. It was the hospital about my dad, so I needed to take it.
Good news, bad news?
Bad
Next
news.
news.
Not good news. Deteriorating. So
All right.
yeah.
Well, I'll keep fingers crossed for you, Sean.
Yeah, thanks. But from that discussion, I don't think we'll see him come out. But there you go. It is what it is.
Do you need to get your head around it?
Yeah, I'm gonna have 10 minutes.
Okay. All right. Are you able to talk later? Just
Yes,
in terms of
I've
follow-up.
got a bit of time today. I've got mostly tomorrow. I'm pretty free, but I've got a bit of time later on. Have a look at my calendar. You'll pick it up.
Okay, cool. I'll do
All
that.
right. See you in a bit.
Good luck. I'll speak to you soon.
Thank you. Bye.